Picture this. A city is burning financially. People are losing jobs. Stores are shutting down. Families are panic selling stocks just to pay rent. And somewhere inside a glass tower, a bank reports record profits again. Sounds backwards, right? Because crises are supposed to hurt everyone equally. But somehow, when the economy catches fire, banks often walk out richer. Here's the uncomfortable part: the system was almost designed that way. Let's say you own a lemonade stand. Business is great. Your friend borrows $10 from you to buy a second stand. Now imagine a storm hits. Nobody buys lemonade anymore. Your friend panics. He needs cash immediately, so he sells you his second stand for $5 instead of 10. You just doubled your business during a disaster. That's basically what large banks do during financial crises. Except instead of lemonade stands, it's houses, companies, stocks, and sometimes entire countries. During a crisis, cash becomes king, and banks control cash. In 2008, while millions lost homes, some of the biggest American banks got emergency money at near zero interest rates from the government and the Federal Reserve. Translation? They suddenly had access to incredibly cheap money, exactly when everyone else was desperate. So while regular people were drowning in debt, banks were buying damaged assets for pennies on the dollar. A building worth 100 million gets sold for 40. A collapsing company gets rescued cheap. Stocks crash 50%. To banks with liquidity, crises are clearance sales. And here's the irony: the same banks sometimes help create the bubble before the crash. Easy loans, risky bets, cheap credit everywhere. The party gets bigger until something breaks. Then the public hears the famous phrase, too big to fail, which is a polite way of saying, if this bank collapses, the entire economy might collapse with it. So governments step in, bailouts happen, central banks print money, interest rates get slashed, regular people call it survival, financial institutions call it opportunity. And this isn't ancient history. During the 2020 pandemic crash, major financial markets recovered shockingly fast after trillions of dollars flooded the system. Meanwhile, many small businesses never reopened. That's the part nobody likes talking about. In a crisis, assets get transferred, usually from the weak to the liquid, from people forced to sell to institutions able to wait. Which raises a bigger question. If banks make the most money when the system breaks, then how much incentive is there to truly prevent the next crisis?